Hello, everybody. Welcome to Clef Investments. Let's continue to discuss the most important investment strategy that this channel recommends, which is buy and hold US broad market index. So in previous weeks, we talked about why it must be US stock market. Why can't you buy other countries' index or global index? I think this is because US stock market is the biggest with the best liquidity and attracts the best companies in the world. So it gives the highest historical returns. And I hope it can continue to deliver the best returns in the future. And we also had a previous video to discuss why we want to buy broad market index instead of picking individual stocks. This is because picking stocks is very hard. There are so many professional money managers. They study the companies, they study the stocks, and it's a zero-sum game. So it is very hard to beat all of them. You may beat some of them sometime, but the easiest is to just buy the broad market index, which tracks the overall performance of the stock market. And another question is why buy and hold? We also had a previous video discussing this. So instead of buy and hold, you could time the market, buy low, sell high. When it goes back to low, you can buy again. But time the market is very difficult. Also because there are many professional money managers that they also try to time the market. And if you want to play the zero-sum game against all of them, it's difficult. So this time, let's talk about another reason why we want to buy broad market index and buy and hold. This is because time the market or picking stocks can generate high tax, actually very, very high tax. So I live in California and I'm gonna use California as an example. If when you sell the stocks, it has lasted for more than a year, you need to pay long-term capital gain tax. And in California, this is 37.1%, which means you only have 62.9% left. So this tax comes from the sum of the federal tax and California tax. Federal tax has 20% long-term capital gain tax, 3.8% Obama tax, and then California has 13.3 state tax. But if you are timing the market and picking stocks, you may also have to pay the short-term capital gain, which is 54.1%. That means you have less than half left, which is 45.9% left. This is because for short-term capital gain tax, you have 37% federal tax, 3.8% Obama tax, and again, 13.3% California state tax. So when you time the market and picking the stocks, many people tend to do this frequently and generate short-term capital gain. And let's use an example to see what's the impact of this tax to your overall return. Okay, so for the tax cost of short-term capital gain, if you make $100 of your gain pre-tax, then after the tax on that year, you only have $45.9 left. Assume you have made 11.6% every year for 40 years. And if you buy and hold S&P 500 in the last 40 years, you can achieve this. But assume you're doing this by doing stock picking and time the market. So if you don't need to pay tax, $1 becomes $80. But if you need to pay the tax every year, then $1 becomes about $8. So this means you have lost 90% to the tax. If you buy and hold the index, in the end, if you have to sell and pay tax, you only pay 54.1% and you lost 54.1% to the tax. But if you do this every year after 40 years, you're gonna lose 90% to the tax to the government. So if you buy and hold S&P 500 index, in the end, you don't even need to sell. You can use short box, which has been talked in many of my other videos in the channel. With short box, you can use money in your stock market without paying any capital gain tax. Okay, what if you make more? If you make 14.25% every year for 40 years, actually Nasdaq 100 made that much in the last 40 years. So now, if you don't need to pay tax, $1 becomes $206. But if you pay tax every year, you only have $12.6. You have lost 94% to the government. So this shows that the more you make, the bigger the impact of the tax. And I'm assuming you are making 11.6 or 14.25%, but those are the return you can get for real if you buy and hold the index in the last 40 years. What if you want to make the return after tax? That means you need to make a lot more before tax. So let's look at this Google Sheet. Okay, in this sheet, on the left column, I showed the name of each number and assume you have $1 million to start with, and assume you want to beat the index, which has a return of 15% or 9%, and so on. And I only simulated 3 years. And in the end, we can calculate how much tax we have. So I tried a few scenarios. First is each year you make the same amount of return. Like they're all 32% or they're all 19% and so on. Or you have uneven return. You make 5% the first year, 30%, and then the last year 24%. Or you don't make anything in several years and make all of your money in the end in 1 year. Or in some cases, you lose money, you gain money, and so on. Okay, let's start from column B. Assume you make 32.68% every year. This is a very, very high return. If you make this much for 3 years, and then you will pay more than $500,000 in tax, and your pre-tax annualized return is, of course, 32.68%. And you're a genius if you can make that much. But after tax, you get 15%, which is the index we're tracking. And you have lost 54.1% to the tax. Okay, so if your goal is to beat the index, which has 9% return, then each year you need to make 19.61%. And the annualized return is 19.65%, which is also very, very high. If your stock portfolio grows at different returns each year, like I just made up a few numbers and I adjusted these numbers so then the final after-tax return is still 9%. So if you do that, the overall annualized return is slightly less. You only need to make 19.35%, slightly lower than if you have even performance. Or if you don't make money in a few years and make all the money in 1 year, you made like 64.3%, then after tax, you also get 9% annualized in 3 years. So the overall return is lower. So this is because you're not paying tax in several years and you're paying tax only in 1 year. So that's why it allows you to have a lower annualized return. So this means if your return goes up and down, it's slightly beneficial to you. But anyway, to achieve 9%, those people who buy and hold the index, you have to reach more than double of the return. And this is very, very difficult because if you look at the professional money managers, most of those money managers cannot even beat the index. That's why, in my opinion, I think buy and hold US broad market index would give you the best bang for the buck. You don't need to spend much time and you get very good return. And your tax bill is very small. Okay, that's all for today. Thank you.